Hey, this is Sasha Evdokov, founder of TradersFly.com and InvestingHelpDesk.com, here to answer a few of your frequently asked questions in detail. Now, today's question is, what does it mean to short a stock? So first, before we get into shorting a stock and what it means, let's take a look at what a long position means, because that's the foundation behind the short position. So with a long position, you buy a stock at a certain price and sell it at a higher price as the stock appreciates in value. Now, the profit that you make is the difference between your buy price and the price that you sell it at. So if we do an example, let's just say in the real world example, let's just say you buy a camera for a good deal, $75 from a friend, and then you go ahead and you resell that camera on Craigslist or eBay for $100. Now, your profit that you make is $25. That is the difference from when you bought that camera from your friend to the time that you sold it on Craigslist or eBay. Now, if you take this example onto a stock example, you can buy the Amazon stock, let's say at $500, and then as that stock appreciates in value over time, you sell it for $575 a few months later, making you $75 in profit. Now, keep in mind here, we're talking about one camera and one share of stock. Of course, if you purchased 50 cameras and sold 50 cameras, your profit would be 50 times larger. And the same thing with your stock. So if you did 50 shares, your profit would again be 50 times larger than your difference in buying and selling the stock. Now, if we look at a variation of this, or the inverse, if you bought the camera at $75, but then you sold it on Craigslist for $60, you lose $15 on the transaction. And the same thing happens with a stock. If you bought the Amazon stock at $500 and you sold it at $480 a few months later, you lose $20 per share. Now, with a short position, what happens is that you're really borrowing shares from your broker. You're selling the shares first in the open market, then you buy those shares at a lower price and profiting from the difference there, because your end goal is still to get to neutral. Just like in the long example, when you have one camera and then you get rid of that camera to sell it, your goal is to be at neutral, is to have that money in your pocket. So how is the money made on the short side? Well, in a real world situation, let's say you sell a camera or you list it on eBay for $125. It got sold, you got paid. Now you need to deliver that camera, so that way you are at a neutral status. So you buy it from a friend for $95 because you knew that camera was available for cheap, and you make $30 in profit after you go ahead and ship that camera out. Now, when you talk about it in a stock world, you go ahead and you sell Amazon stock at $550, meaning you borrow shares from your broker and you sell that stock at the $550. And then you buy it back at, let's say, $450 as that share price continues to go down. Because remember, when you're buying something back, you want it at a lower price, and then you make the difference. So you make $100 in profits in this situation. So let's go ahead and take a look at a profit and loss picture here on Amazon. So here, if I change the stock price to, let's say, one share or one contract, so now what you can see is this is buying a share of stock. And you can see that if I buy it here, the current price is right around $620. If I buy it right now and it goes up to $640, I make about $20, because the difference with one share up to the $640, that's a $20 difference. So I'd make about $20 as long as that stock continues to the upside. Now, if it goes the other way and I, let's say sell it at $570, then I would lose about $50, because that is the difference between the $620 and the $570. Now, if I go the other way and I sell the stock first, the graph is actually going to look completely opposite. So now, if that stock goes to the downside, if it goes down, that's where I make money. So remember, first I'm selling at $620. So what do I want the stock to do? I want it to go down. So if it gets down to $590, now I make about $30 in profits, because $590 to $620 is a 30-point spread. So I make $30. Now, if it goes to the upside, let's just say to $700, I would lose $80, because now I would have to cover to get back to even, to get back to zero shares. I'd have to cover that, and I'd have to cover it at the $700 range, and that's an 80-point spread difference, therefore losing money on the trade. So that's the difference. Basically, when you're looking to sell the stock, you want to sell it at a higher price and buy it back at a lower price. That's what shorting is all about. If you're looking to invest for the long term, you're looking for stock appreciation, and in that case, you want those shares to go to the upside. So what is it that you need in order to be able to short a stock? Well, you need a margin account with your broker, since the broker is lending you stock at the time from its inventory or another one of its customers. Keep in mind that sometimes interest is charged on margin accounts or for keeping your short sale open. So you need to contact your broker to learn their rates and fees regarding short positions. Some of them are more favorable, others of them are a little more strict. So you'll have to contact your broker directly and figure that out. Most of the time, you can hold a short position for as long as you want. However, there may be times where you can be forced to cover if the lender, in this case your broker, wants the shares back. This does not happen often, but it can happen. And one of the reasons why it does happen sometimes is, let's say, for example, you are short this stock, and let's just say you are short 100 shares. Now, as that stock price continues to move to the upside, your losses continue to accumulate. So even though the current price, and we shorted it at $620 per share, or $619, if that stock continues to run to the upside, your losses start to become really unlimited when you think about it, because a stock can only go to zero if you bought the stock. But if you short a stock can really go to the moon. They can go to, at $1,400 here, you would owe $78,000 on those shares. So it's really important that you really understand that shorting has unlimited risk. But in reality, I mean, would the Amazon stock go from 620 to 2,400 in a day? Probably not. But sometimes biotech companies will jump around and they will move on you on a dime, depending on drug trials, drug treatments, and testings and things like that. So those things can whip around, but is it realistic? No. Can it happen? Yes, it can happen. So you need to understand the dangers behind it before you actually short stocks or short any kinds of shares, because there's some serious risks involved if you don't understand them. All right, so thanks for joining me. So remember, when you're going long, you're buying at a lower price, selling at a higher price. But when you're shorting, you're trying to sell it at a higher price because you're borrowing shares from your broker, and then you're buying it back later at a lower price, capitalizing on the difference. Now, if you enjoyed this question and answer session, then feel free to see more questions and answers at investinghelpdesk.com. And if you want to get some detailed investing and trading education, then visit my primary website at tradersfly.com. And if you want to take a look at our podcast, courses, see some of the critical charts I'm watching, or even subscribe to us on YouTube, then feel free to click one of these buttons or links right here on this page, and you'll be taken right there to that corresponding location. Thanks again, and I'll see you next time.